Well, I welcome you to this session of our Limited Education Week 2020. Like you, I miss not having Education Week, and I look forward to meeting with you next year on campus. By way of introduction, my name is Scott Peterson. I've been presenting at Education Week now for a little over a dozen years. I own an investment management and tax planning business that specializes in working exclusively with retired families. My team and I work with hundreds of retired families across the nation, and I've been managing money for about 34 years, so I'm starting to get the hang of this. But seriously, I've learned some valuable lessons that I'm eager to share with you today. So even if you manage to build up a sizable nest egg during your working years, implementing the right way to withdraw those funds is every bit as important as saving the money was during your working career. Mistakes made or at or during retirement can be unforgiving. Important decisions have to be made, and there are no do-overs in many instances. My goal today is to provide you with actionable retirement solutions. I will demonstrate how we professionally turn a career's worth of accumulations into a retirement full of income. My hope today is that after today's presentation, your life becomes less worrisome and a little more secure. So let's talk about today's retirees. They're the luckiest crop to have ever lived. Today's retirees are healthier, wealthier, happier, cleaner, kinder, safer, better educated, more equal, more charitable, and more technologically advanced than any previous generation of retirees. Our opportunities are endless. We have more leisure time. I used to say we travel more. Well, I'm sure we'll travel more again, okay? We live longer and more comfortably than those that have got any generation that's gone before us. Think about this. We carry more technology in our pockets and purses than the Apollo space program had to send men to the moon. While I sleep, my house vacuums itself. My computer searches for ancestors that need their ordnance work done. When my car needs air in its tires, it emails me to let me know. And today, the technology for self-driving cars and the delivery of groceries by drone is perfected and awaiting regulatory approval. The Imagineers at Disney and the creators of the Jetsons did not even come close to imagining the conveniences of our day. Ironically, the wonderful lives and retirements that we have inherited have also given us challenges to grapple with that no previous generation has had to consider. The way I see it, today's retirees faced three major challenges that are unique to this generation. So for the past 200 years, life expectancies have crept up by 3 months per year. This trend will only accelerate as billions of dollars worth of research are poured into the development of anti-aging drugs and genetic therapies. In the very unlikely event that medical discoveries don't yield any monumental breakthroughs, the gradual increase in life expectancy that has been experienced for 2 centuries will still give a child born today the expectation of living to age 100. Because of longer life expectancies, many retirees face the very real risk that they will outlive their money if they don't plan for a lengthy retirement. Challenge number 2 is that of inflation. A retirement lasting 30 or more years is a game changer. Although inflation has always existed, no previous generation has had to deal with inflation to the extent that today's retirees do. Why? Because previous generations of retirees didn't live long enough for inflation to materialize. When you think of it, inflation is a thief, and it steals your future day by day, year by year during retirement until the once prosperous lifestyle you worked 3 or 4 decades to create is gone. The confiscation of wealth by inflation is stealthy. It happens in broad daylight, right before your very eyes. Most victims of theft by inflation don't even realize they've been ripped off until it's too late. Recently, inflation has been quite low, but historically the average inflation rate has been more than 3% annually. To put that into perspective, at a 3% inflation rate, A dollar's worth of purchasing power today will only purchase 41 cents worth of goods and services 30 years from now. That's a 59% cut in pay if you don't keep your investments up with inflation over a 30-year retirement. An additional inflation concern is that of health care related expenses. Retirees spend more on health care than any other group of people, and inflation for health care related items is growing at double the national inflation rate. Now, inflation is something we can do something about. We can combat the effects of inflation by keeping our investments growing faster than the inflation rate. Which brings us to challenge number 3, the burden of investment management, or the personal responsibility that each retiree now has to manage their own investments. Previous generations of retirees received monthly pension checks from their previous employer. Most members of this generation won't be that lucky. Over the last couple of decades, the responsibility to provide a stream of retirement income has shifted from the employer to the employee. So consider yourself very fortunate if you have a pension. The personal responsibility the retiree has of accumulating, properly investing, and then efficiently distributing retirement funds can be overwhelming. Most retirees are completely unprepared for the task. Few have any formal training, education, or experience managing investments. No investment plans are followed because, frankly, there are no plans. Employees drop money into 401ks with little direction or thought as to how their money should be invested. Investment discipline is unheard of, as investment decisions are driven by the daily news, which will never produce a positive outcome. Many employee investors recognize that they don't have the knowledge, the temperament, or the desire to assume the responsibility that has been thrust upon them. So no matter what your particular skill set might be when it comes to investment management, the reality is the responsibility to grow a retirement nest egg and then subsequently distribute this money over a 30-year retirement belongs to you. All of you became investment managers, like it or not, and you hold the keys to your financial future, whether you're ready or not. So given the challenges you'll be facing, you'll need a plan that considers longevity, considers inflation, and a plan that can guide your investing throughout retirement. I think about this as members of the Church of Jesus Christ of Latter-day Saints. We have wonderful examples of what successful plans look like and how they should be managed. We know of the plan of salvation, the plan of redemption, the plan of happiness. The creation, the fall of man, the atoning sacrifice of our Savior, the resurrection and final judgment are all part of our Heavenly Father's plan to bring to pass the immortality and eternal life of man. We have tremendous responsibilities to our church and our family during retirement, and all of our activities will require income, and a personal retirement income plan is important to successfully fund all these important endeavors for the rest of your life. Now, in a minute, I'm going to show you how a professional retirement income plan is created. Certainly, the plan I'm about to show you isn't the only way to create retirement income, nor am I assuming that you'll be able to copy or follow this plan with exactness. I am showing you how a plan is constructed in hopes that you may glean a couple of ideas from it to implement in your own situation. So before we create this plan, we need to identify what genuinely determines investment performance. At Education Week, in a non-COVID year, I take a whole session to identify investment myths or fallacies. I do this because a plan built of false investment ideas or incorrect assumptions will not sustain you throughout retirement. Thankfully, business schools across the nation have researched for the answer to this very question: what really determines the growth of my investments? So let me share the conclusions, share their conclusions. A groundbreaking study was published in June of 1991 in the Financial Analyst Journal entitled Determinants of Portfolio Performance. This study identified the human factors that contributed to investment performance. The findings of this and subsequent research concluded that investment activities such as timing the market, or beating the markets through creating a superior investment selection contribute very little, if any, to an individual's performance. Because frankly, over a long period of time, nobody's been able or has proven to successfully or reliably accomplish these tasks. So you might ask, so if market timing and stock picking doesn't work, what are the human factors that really determine investment performance? Well, there's overwhelming evidence that it's asset allocation. Simply stated, asset allocation is how your money's invested. So whatever asset class you have your money invested into determines your outcome. Now, an asset class can be described as a group of economic resources that share similar characteristics such as risk and return. So stocks are an asset class, bonds are an asset class, real estate's an asset class, and so on. So whether you're invested in stocks versus bonds versus real estate, that's what really determines your growth. So how do you go about determining which asset class you should invest in? Before you can decide this, you must answer this all-important question. So how long can my money stay invested? Ascertaining a portfolio's time horizon, or how long your money could stay invested, is the single most important determination that must be decided before investing. Obviously, if you're investing your money to purchase a car next year, you'll invest that money differently than if you're saving money for retirement in 20 years. Long-term money and short-term money needs to be invested in opposite types of investments. Allow me to explain. Since 1926, a single dollar invested into Treasury bills would have grown to $22 today. A dollar invested into long-term government bonds would have grown to $159 today. And a dollar invested into large U.S. stocks would have grown to $9,244 today. Stock-based investments, which we will call equities, are one of the few investments that have managed to stay ahead of inflation over the long term. As you look at the chart, you can obviously see that equities were the place to be long term. But the price we pay for inflation-beating returns is volatility. And equities experience extreme short-term volatility that can last for sometimes 2 or 3 years. You see those little valleys. Here, let me get my pointer on those. The little peaks and valleys along the equities lines, they don't look like that big of a deal on the screen. But do you remember those little valleys? Do you remember when you're in the middle of those little valleys? Do you remember what it felt like back in 2000 to 2003 when the dot-com bubble burst and the stock market plummeted? Stayed by about 50% and stayed down for a couple of years. How about the financial crisis of 08 and 09, where likewise the stock market went down about 50%? Even this year, the pandemic of 2020, where the stock market earlier in the year dropped by 35%. Thankfully, it's all rebounded. But I guess the point I'm trying to make is long-term stocks are a great place to be. But because of the short-term unpredictability of equities, they're not a reliable source to draw income from. Therefore, bonds, money market accounts, T-bills are considered that we call fixed income investments. We need to have those also. Now, these type of investments will never keep up with inflation in the long term, but they don't experience the volatility of equities. Therefore, retirees need to consider their time horizon and have a combination of low volatility investments in retirement to provide a safe haven to draw income from when equities retreat. But retirees also need equities in their portfolio in order to keep up with inflation. Now, Albert Einstein understood the importance of time when it came to investing. When asked to name the greatest invention in human history, he simply replied, well, it's compound interest. I likewise am impressed by compound interest. To me, it's almost magical. Compound interest is when there's when an investment earns interest on top of interest on top of interest and so on. Those who figure out how to harness the power of compound interest become wealthy. Those who are in debt and allow the power of compound interest to work against them are forever poor. The concept of compound interest is important to understand because the retirement income plan I'm about to introduce to you incorporates the magic of compound interest that so impressed Mr. Einstein. So there's a simple math calculation that reveals how compound interest works. I have heard this calculation referred to as the law of 72. If you don't get anything else from this presentation today, get to know this formula that I'm showing to you. And please show your kids and grandkids that first of all, they're going to think you're really smart, and then they'll be grateful to you forever for having been taught this concept. But the two components that drive compound interest are time and the rate of return on your investment. So let's go over this right here. So how it works out is 72 divided by whatever return you're getting on your investment tells us the amount of time it takes an investment to double in value. So for example, 72 divided by, let's say you're getting a 10% on your returns on your stock portfolio, it tells us that every 7.2 years, your money will double. So in practice, at a rate of return, if you had an investment and you were to expect a 4.8% return on a $100,000 investment, then I would simply divide 72, here's my formula here, by 4.8, and tells me that money at 4.8% interest doubles every 15 years. Okay, and so my 100,000 would double to 200,000 in 15 years. In another 15 years, the 200,000 would double again to 400,000. Now, using the same formula, we find that money getting twice the return, or 9.6%, doubles every 7.5 years. Now, none of this information may seem that spectacular until you look at the results over a long period of time. As you can see from the chart, the results of compound interest are truly fascinating. A $100,000 investment getting 4.8% over 30 years has the chance to double twice, allowing it to grow to 400,000. Okay, so right here. So whereas the investment getting a 9.6% return will be able to double 4 times, allowing that initial $100,000 investment to grow to $1.6 million in 30 years. So thanks to compound interest, an investment that's getting a 9.6% return versus a 4.8% return doesn't give you twice as much money in 30 years. It gives you 4 times as much money in 30 years. That's why we like compound interest. Okay, now that we've identified the retirement challenges, we've concluded that asset allocation driven by your time horizon is the primary driver of investment returns. And we understand the importance that compound interest plays in your future. We're ready to build a retirement income plan. So the retirement challenge that you have is that of organization. Every home has a junk drawer where random, unorganized items are kept. At my house, it's the kitchen. So if I'm ever in need of a paper clip, a pair of pliers, or a stapler, I look in the old junk drawer. Now, it's not that the items in the drawer don't have value. They do. It's just called the junk drawer because it's unorganized. Now, as someone who's managed retirement money for 3 decades, I find that helping a new retiree organize the various investments and benefits they've collected over a working career into a stream of income is similar to organizing the old junk drawer. Now, I'm not suggesting that these items don't have value. On the contrary, they have tremendous value. But think about your own junk drawer of investments and benefits. There's the Roth IRA that you started years ago. How about some inheritance? The 401k from your ex-employer, your existing 401k. How about your Social Security and your pension benefits? And maybe a lump sum pension from an old employer. Anyway, creating a reliable stream, a reliable, long-lasting tax-efficient, inflation-beating stream of investments from your junk drawer of investments and benefits is a daunting task. But you've got to get this right if you're going to enjoy retirement to its fullest. So before we build this plan, let's just define exactly what it is we want our plan to accomplish. I suggest 4 things. We need our plan to be goal specific. Now there's a big difference between a person who says, when I retire, I would like a cabin at the lake, versus the individual who says, I want a cabin by the lake when I retire in 20 years. I estimate that it will cost $600,000. Therefore, I will need to save $1,300 per month for 20 years and get a 6% return on that investment to accomplish my goal. Okay, clearly the first statement is a wish or a dream. I want a cabin by the lake. The second statement is a plan. Now, any program that does not offer date and dollar specifics is a wish or a dream, not a plan. And in the world of finance, dreams rarely come true, but plans often do. So we need our retirement income plan to be goal specific and define exactly how much money will be needed and exactly when it will be needed. We need our plan to provide an investment framework. When it comes to investing in retirement, we need to match our current investments with our future income needs. In order to do this, we need to determine how much income you will need, first of all, and second, we need to determine when you'll need that income. If we know how much you need, if we know when you'll need it, and given this, with this information, we can determine how you should be invested. And I'll show you in our plan how that works out. Third, we need to provide a distribution framework. At retirement, you will be managing the biggest sum of money you'll ever have, but it has to last you a long time. A distribution framework will help you to answer 2 very important questions. First, from which one of my accounts should I take my income from? Is it best to take income from your IRA, from your Roth IRA, or how about your joint account? You know, there's serious tax considerations to be made when drawing income. And second, how much can I or should I withdraw from my investments? This question must be figured out if you're going to have a sustainable income stream throughout retirement, and if you're going to be able to enjoy your retirement experience to the fullest. In managing money, I've noticed 2 tendencies. Okay, first, those that overspend in retirement. We have people that save for retirement all their lives, and now that they're retired, they're going to spend the money that they've been saving however they want and buy whatever they want. Okay, they buy the condo in St. George, they help their kids with a business, and whatever. But I've seen some people blow through all of the money they've saved in the first 10 years of a 30-year retirement. Now, the more common, other extreme of this is the tendency for people to underspend. Okay, they're scared about their future. They know that this chunk of money they have has to last a long time, and they're afraid to spend any money at all. Therefore, they shortchange their retirement opportunities because they're simply afraid of spending money. So a plan will help you to have the knowledge, the discipline, to take out the appropriate amount of income from your investments from the right accounts. Okay, number 4, a plan will help you to recognize and minimize risk in your own situation. So let's define what risk is. Risk is the chance of losing purchasing power. Now, all investments have risk, but they have different kinds of risks. With some investments, the risk is very gradual, such as in the case of inflation. With other investments, the risk is immediate. Let's say a business goes bankrupt, goes out of business all at once. But all investments have risk. Real estate has liquidity risk and market risk. Bonds have default risk, interest rate risk, and inflation risk. How about individual stocks? They have bankruptcy risk, market risk. Your FDIC guaranteed bank deposit, it has risk. It has inflation risk. Okay, so many investors tend to either ignore the risks in their own situation or they don't understand the risks that have the greatest potential to inflict damage. Now, the two most significant risks that retirees faced is first, losing purchasing power to inflation, and second, losing money investing in equities without following a plan. And again, without a plan, emotions drive your decisions, and that will never produce a good outcome. So what I want you to remember that over time, the risk of owning equities goes down. The longer you own them, the better chances you are of making money. And over time, the risk of inflation goes up. Okay, so we need a plan that protects your short-term income needs from stock market downturns while you protect your long-term income needs from inflation. So let me give you a little bit of my history. In following 9/11 and the dot-com bubble bursting, I was very frustrated with the investment process. You know, it seems like no economist got things right during those years. Okay, so because in the investment process, what happens? You know, you try to find an economist that kind of has a pretty good track record of predicting where the economy is going and so forth, and then you buy your clients' investments around that information. Okay, now, but I recognize that the traditional method of managing money, again, studying what the economists were saying and then buying investment products for my clients that matched their best guess, this didn't work. Okay, and by the way, it still doesn't work. So I recognize the need for my clients to hold low volatility fixed income investments, such as bonds and money market accounts, as well as inflation-beating equities in a portfolio. But I didn't know how to proceed to create the proper mix of investments and how to manage such a portfolio going forward. So anyway, I was searching for a better way to invest. In 2007, I came across a paper written by William Sharpe. He's a Nobel Prize-winning economist from Stanford. In his paper, he suggests that when a person retires, the retiree's investment funds should be divided into 30 separate accounts. Each of these accounts would then be responsible for providing income for 1 year of a projected 30-year retirement. Okay, so there'd be an account dedicated to providing income for the first year of retirement, an account dedicated to the second year of retirement, and so on until 30 years worth of retirement income could be covered. So the objective of the money set aside to create income in the first year of retirement is safety of principal. It can't be subject to market fluctuations. This is where you're getting your monthly check from, okay? So neither fighting inflation or getting a large investment return is a concern with account number one because of the shortness of its duration. It's going to be spent in the first year. So safety and stability are paramount. First year money should be held in ultra-conservative investments that are not subject to volatility. Now, on the other end of the spectrum is the money that is designed to provide income during the 30th year of retirement. The objective of this account is to keep up with inflation. So dollars within this account have to be invested in inflation-beating equities. Short-term volatility is expected, but irrelevant in this account. This money won't be needed for 3 decades. So speaking collectively, equities have never lost value and have always beaten inflation over time. So 30 separate accounts would therefore start as being very conservatively invested and then would get more progressively more aggressive as the need for income from these accounts is pushed out over 20 and 30 years. By following this program of investing, the retiree's short-term risk of market volatility is dissolved and the long-term threat of inflation is managed. Now, as much as I like Sharpe's concept in theory, it was just a theory. It wasn't practical to implement. Okay, I didn't want to create and manage 30 separate accounts for my retirees, and certainly my retired clients didn't want to watch 30 separate accounts either. The hassle and the expense of this endeavor rendered this academically solid theory of time segmenting retirement funds impossible. As I thought more about this, I realized that I could turn Sharpe's theory into a workable model of investment management by making a simple adjustment. I changed the time period that each account was responsible to create income for from 1 to 5 years. So managing 6 accounts that provided income for a 5-year segment of time versus the original 1-year time frame was workable and followed the original objective that Sharp expressed. I therefore ended up with accounts that provided income for years 1 through 5 of retirement, an account that covered income for years 6 through 10 of retirement, and so on, until 30 years of retirement were covered with just 6 manageable investment portfolios. In my office, we call these 5-year periods segments. So once all the wrinkles of transitioning an academic idea into a workable methodology were ironed out, we launched our trademark version of time segmentation that we named the perennial income model. I will share details with you about how we constructed this model. Now, as I show you these details, try to envision how you would incorporate some of the concepts I'm sharing with you in your own situation. I have an experienced staff and the tools that help us to create and manage the models that we use with our clients. And you won't be able to exactly duplicate our process, but hopefully you'll be able to extract some ideas to enhance your own situation. So, okay, enough talk. Let's get building this thing, should we? I'd like to now introduce to you the Smart family. Now, the Smart family is not a real family, but their circumstances mirror many of the retirees that we come across. Tony Smart, he's a 65-year-old engineer, has been diligently saving for retirement throughout his long career. He has come to the point where he and his wife, Kathy, are ready to do something else with their lives. Indeed, they're ready to retire. Now, they have accumulated $1 million in their 401k and IRA accounts. They want to know how this $1 million should be invested in a time-segmented program and how much income they could expect to receive from that sum of money. They would really like to pass the full $1 million balance to their children upon their deaths, if at all possible. Now, I would like to have you note that I'm going to show you a distribution plan as to how to manage and distribute $1 million. This plan that I'm sharing with you today is not just for millionaires. It works with smaller as well as larger amounts of money also, okay? I'm just using $1 million because it's a nice round number and it's easier to follow as I explain how the time segmented approach works. Now, we're going to invest all of the Smart's money, but we're going to break their investments into 5 different investment portfolios that are designed to cover 5 years worth of their retirement. Now, I'm only going to show the Smarts of the 25-year versus the 30-year plan simply because our time is limited to today. So, of the $1 million, we're going to split off $220,979 of their $1 million and dedicate it to segment 1. Segment 1, again, is going to provide income for the first 5 years of retirement. Now, the objective of segment 1 is safety. Now, segment 1 is going to spin off $3,774 a month for 5 years. Again, this money has to be safe from volatility. It can't be in equities. Inflation, again, is not a concern because we're going to spend the money in a 5-year period of time. But this is the money the Smarts will be living on for the first 5 years. I want you to notice, too, that I'm assuming just a 1% rate of return on this account. Can you, should you get a better rate of return than 1%? Well, yes, you can, and yes, you should. The time segmented plan that I'm showing you today is not guaranteed, but you can make it as conservative as you want it to be by simply plugging conservative assumptions into the plan. I find it better to use very conservative assumptions when putting together a segmentation plan. It is better to underestimate the returns than it is to overestimate returns and then run out of money during retirement. Obviously, if the program we're building works with the low assumptions that we'll be using today, it will only work better in reality as your investment returns exceed the conservative assumptions that we'll be using. Okay, so when it comes to assumed rates of return, I'll be referring to a study by Vanguard that provides some historical context of the returns the various portfolios that we'll be using, returns of the various portfolios that we'll be using within our plan. So, okay, so let's say why we spend the money in segment number 1. For the first 5 years of retirement, the balance of the $1 million is growing. Of the balance, we're going to slice off another $220,979 and allocate this to segment number 2. Now, segment number 2 will take over the role of providing income to Tony and Kathy once segment 1 runs out of money at the end of 5 years. So since this money will not be needed for at least 5 years, it can be more aggressively invested than segment 1. But I would say it can't be significantly more aggressively invested. A prolonged bear market could last longer than 5 years. So it's invested in a conservative growth portfolio, which means it's about 20% stocks and 80% fixed income, so bonds, money market kind of stuff. Now, according to Vanguard, a conservative growth portfolio has averaged a 6.6% return historically. Now, and we are just going to assume just a 3% rate of return during the 5 years that's invested before it's turned into income in year 6. Now, if it were to get the assumed 3% growth rate, the original investment of $220,979 will grow to the goal or the target of $256,693 by the beginning of the 6th year in preparation for the distributing income in years 6 through 10. I want you to also note that in the 6th year, the smarts are getting a cost of living adjusted raise. Okay, so their monthly income goes from $3,774 to $4,384. That's because within our program we build a 3% cost of living adjustment and then adjust every 5 years. Okay, so you'll notice that. Okay, meanwhile, while segments 1 and segments 2 are being spent, segment 3 is working for you. Segment 3 provides income for the third 5-year segment of retirement, or years 11 through 15. Now, because this money is not necessary to provide income for 10 years, this money can and should be more aggressively invested than segment 2. About half of the portfolio needs to be invested in equities, and the balance should be invested in less volatile, fixed income types of investments. Historically, a 50-50 mix of stocks and bonds has averaged a little bit over an 8% rate of return. We'll assume the conservative growth rate of 5% on segment 3. And as you can see, the segment 3, so we're going to assume 5%. We're putting 181 into it. As you can see, the goal is to have this grow by 5% and be worth $298,000 by the time it's needed for income in year 11. We see in year 11, again, Kathy and Tony get a raise. We go from $4,384 to over $5,000. Okay, you're starting to see how this works out now, right? Okay, segment 4 is invested into a moderate growth portfolio which consists 70% equities and 30% bonds. According to Vanguard, this mix would have historically generated an annualized average return of about a little over 9%. Now, segment 4 is given $141,000 of the original $1 million, and segment 4's goal is to turn the $141 into $346,000 by the time it's scheduled for producing income in year 15 of retirement. So this goal will be realized if segment 4, this gets our assumed growth rate of 6%. Again, the smarts take a raise in the 16th year. Segment 5 is given $99,000 of the original $1 million and has 20 years to grow before it turns into income in years 21 through 25. Therefore, we'll invest mostly in equities. A growth portfolio, which is 80% stocks, 20% bonds, has averaged 9.6% historically. We're going to, again, is to assume a 7% growth rate as we project the initial $99,622 investment growing to over $400,000 in 20 years. This portfolio should be diversified and invested in inexpensive index-related investments, such as index funds or ETFs, that contain both large, medium, and small U.S. stocks, as well as some international stocks. So that brings us to our last segment. The last segment is what I like to call the legacy segment. Remember that Tony and Kathy wanted to leave their original $1 million to their 4 children. So this money, the legacy money, should be invested in a diversified all equities portfolio, so 100% stocks of a wide variety of stocks. Now, historically, an all equities portfolio has averaged more than 10%. We'll assume an 8% return. Therefore, if we get 8%, the $136,000 originally invested is in the legacy account will grow to the original $1 million. You see this. So we start here, $136,000 will grow to the original $1 million after 25 years. Okay, and again, Tony and Kathy wanted to leave the full $1 million to their kids if they possibly could, and they can. Okay, so during the latter segments is where you can really see the power of compound interest that so impressed Albert Einstein. Notice here, we put in 136, it's worth $1 million if we just let it sit and let it grow with compound interest. Okay, so now here's the big picture. I want to point out a couple things. First of all, again, and I'm harping on this because it's so important, but our assumptions, 1, 3, 5, 6, we're not assuming 10, 12% rates of return. We're assuming lower rates. Can you do better? Yeah, I would hope you can. But I think about this. What good would be realized by using inflated numbers? You only deceive yourself into taking higher income, but then in the end, you'll be disappointed. History and my personal experience tells me that these assumptions are attainable. If you disagree, you can always choose more conservative assumptions in your situation. Another thing I want to point out is the total value column. That's this column right here. Okay, now you would think that if we're spending all of segment 1 and that money's gone, and then spending all of segment 2 and then that money's gone, that the total account balance would be depleted. Okay, well look at this. By following this methodology, it stays right around $1 million throughout Tony and Kathy's entire career. Reason being, of course, because, well, segment 1, segment 2 are being depleted and spent. Segments 3, 4, 5, and 6 are growing. Okay, so that's why we maintain that $1 million balance. Okay, then I want to show you. I want to point out the total distribution column. That's this column right here. Okay, so this is the income that the smarts take over 25 years. So you can see it's inflation adjusted, so their checks are getting bigger and bigger over time. And they end up taking $1,562,000 out of their accounts, and they still have the $1 million to live on or to pass on to their heirs upon their death. I will tell you there's not an annuity on this planet that will produce this kind of income and return your principal in 25 years. So buyers of annuity, beware. Okay. Can we pull more income out of this model? Well, the answer is yes. All we do is that we leave less of a legacy right here. Okay, so now many of you are thinking, well, this is great. I'll just copy this plan, which is okay. That's why I'm doing it. I wouldn't mind you copying it, but let me warn you that there's just so much more to this than a spreadsheet. So even though you may be very adept at creating spreadsheets or you're able to put together a plan following this pattern that I've provided, please don't think that you're done. Quite to the contrary. You have just begun. A time-segmented distribution plan takes a couple of hours to create and 30 years of discipline to successfully implement. Those who create spreadsheets and invest and then forget about their investments or they abandon the plan will not have a successful outcome. When investor discipline fails, the plan fails. The essential step of harvesting a time-segmented program is really where the rubber meets the road, not in the creation of a spreadsheet. Let me explain what harvesting is all about. The process of harvesting is transferring riskier, more volatile investments into a conservative and less volatile portfolio once the target or goal of each segment is reached. A fruit farmer toils throughout the year in his orchard, fertilizing, pruning, spraying, in irrigating his trees, all this work is done because the farmer knows that in the fall, in a very short window of time, the trees will produce delicious fruit. He knows he must harvest the fruit when it's ripe and ready to be harvested. Harvesting the fruit too early or too late in the season will ruin the fruit. Now, just because the fruit is ready to be harvested only on a select few days of the year doesn't mean the fruit needs to be eaten only during the harvest. There are many methods that are used to preserve the fruit once it's gathered. The fruit can be frozen, canned, bottled, dried, or whatever to preserve its flavor and nutritional value for the future. The means of preserving the fruit is not nearly as meaningful as harvesting the fruit when it becomes perfectly ripe. So just as the farmer picks his fruit at the appropriate time so it can be preserved for a future day, retirees should harvest their investment gains and preserve them once the goals are achieved for each of the segments. Unnecessary risk is brought to the time segmentation plan if it is not properly harvested when the investment has ripened, or in other words, has grown to its target amount. So getting back to our chart, without harvesting, the time segmentation model becomes more aggressively invested as the retiree ages and gets into the latter segments of the plan. Having 80 and 90-year-old retirees with all their money invested in long-term, aggressive equity portfolios does not make any sense at all. Fortunately, that is not how the program works if the time segmented plan is properly monitored and harvested. The process of monitoring and harvesting are imperative to the success of a time segmented distribution plan. So let's talk exactly how harvesting works. As you can see, the target or the goal of every segment are the dark green numbers here. Okay, so we want to invest, there's our target, there's our goal. Okay, so once we hit the green numbers, whatever year that is, then we need to get into more conservative investments. Now, one of the primary reasons that we use conservative growth assumptions is because we want the target or goal for each segment to be reached prior to the date it will be needed to provide income. So let me highlight segment number 5 to show you how this works out. So here's segment 5 here. In segment 5, we invested $99,622. We know that a 7% rate of return, we know that at a 7% rate of return, this money will be worth over $400,000 in 20 years when it will be needed to produce income for years 21 through 25. Now, because we know the money invested in segment 5 won't be needed for income for 20 years, this segment is invested in a growth portfolio, which is about 80% stocks and 20% bonds, so it's a more aggressive portfolio. Now, according to the Vanguard study, a growth portfolio has historically averaged an annualized return of 9.6%. Again, we're assuming only a 7% growth rate for segment 5. So it would be entirely possible that segment number 5 could grow by more than 7%, by more than a 7% annualized return. If this segment were to average an annualized return of 9% instead of the assumed 7%, the original investment amount of $99,000 would grow to the target amount of $402,349 in years 16 and 2 months, okay, rather than in the projected 20th year. So once the target amount is reached, no matter what year that happens to occur, the investment needs to be harvested and preserved. In other words, the equities in the segment that has obtained its target goal must be traded for more stable and conservative investments. Harvesting adds order and discipline to the investment process, which results in better investment returns. Investments are sold when goals are met, which means there is less selling based upon emotion. Okay, so a time segmented plan. Let's talk about what this does for you. It is goal driven. Okay, it matches your current investments with your future income needs. Time segmented plan creates a framework for investing. Because you have a goal-specific plan, you know specifically how to be invested. You understand the purpose of each of your investments, and you know when to sell. It allows you to invest with confidence. A time segmented plan aligned with a program to harvest gains reduces investment risk if the plan is followed. Number 3, it provides a framework for distribution. You will know how much you can and how much you should take out of your investments. The plan helps you with distribution discipline. It helps you to monitor your own spending behavior. Okay, it creates a framework to manage risk. Your greatest short-term risk is stock market volatility. Your greatest long-term risk is inflation. The time-segmented plan addresses both of those risks. Less volatile investments provide for immediate, safe income needs, while more aggressive, higher-earning investments will help you keep up with inflation in the long run. You know, since we've been doing this now for, 13, 14 years, we've been through a couple of market crashes. And so let me explain other things that this program will do that I didn't realize at the time when I created it. It will help you coordinate your income sources. Okay, so Social Security, pensions, your investments, how much you should pull out. So once your income is laid out as it is in this format, you can identify tax savings opportunities. Roth IRA conversions can be a powerful tool when appropriately used within a plan. Now, without a plan, it's very difficult at best to figure out how to save money on taxes in the future. To figure out if a Roth conversion makes any sense in your own situation. Number 6, it works as a bad luck insurance policy. Now, some of you may know people who were unfortunate to have retired in 2007, right before the financial crisis of 2008 and 2009. As a reminder, stocks plummeted 50% during these years. I know several retirees who were forced to sell their equities, sell their stocks at a huge loss just to pay the bills, just to live. Retirement accounts were devastated during this time period. If you happen to be one of those unlucky people who retire at the beginning of a bear market, you're protected. Your income will not be coming from your equities. You will be giving time the opportunity to work in your behalf. Another benefit, it protects you from your older self. I don't know your age right now. You might be 60, 55, 65, 70, and you might have done a great job managing your money. But will you do a great job in 5 years, in 10 years, in 15 years? We find it's very important to have a plan like this in place. So as you age, simply because you're familiar with the plan, you're going to follow the plan, you're going to be less prone to be making investment mistakes, and less prone to be subject yourself to some of the silliness that's out there. You have a plan, you just need to stick with the plan. And along those lines, it will leave the surviving spouse a plan to follow at death. Now, if you're watching this presentation, chances are you're the one that manages the money in the family. Okay, what's going to happen when you're gone? What kind of plan is your spouse going to follow? Okay, I've seen more fraud at the death of the first spouse during my career than at any other time. Widows and widowers are very vulnerable at that stage, and anyway, bad things can happen. If the spouse knew they simply had to follow the plan that's been in place for 20 years, it really protects them. So, time segmentation. Now, there's all sorts there's a lot of varieties of this. Of course, I think our plan's the best one in the world, but you know what? There's going to be other advisors that have a time segmentation plan. You can talk to them about how they do things. But I just find it's a common sense approach to managing your investments during retirement. Time segmented approach to managing money during retirement is not guaranteed. It's not trying to get you the highest return in the universe. It's a plan that's designed to get the retiree the most consistent flow of inflation-adjusted income throughout retirement at the least possible risk once all risks are considered. I have a question for you to think about. How do you think large pension plans invest the money that will be eventually sent out to their recipients? You think it's all sitting there in a big pot of cash that they distribute pension checks from? No. They likewise match their current investments with the future income requirements of the pension plan. Okay, so they're doing the same thing that we are, just on a different level. So a time-segmented pattern, this time-segmented pattern has been successfully used by pension plans and endowments for 100 years now, and it works. A time-segmented plan provides peace of mind. Let me just tell you how I found this out. In 2008 and 2009, we'd had the plan created for about a year. Okay, then the big drop of 08 and 09 came along. Again, stocks were down about 50% at the time. I had only had a chance to convert maybe half of my clients to a time-segmented distribution plan. The other half had the old method of investing that we'd always used. It was a stark difference in the reaction to the crash that the people had that had the plan versus those that didn't have the plan. Those that didn't have a time-segmented plan would come into the office and be saying things like, well, we need to get out of stocks. You know, I don't care. Let's lock in the losses. I understand that's probably not the best thing to do, but you know what? I can't stand the markets going down anymore. I can't see my account go down anymore. You know, we got to do something different. Versus those that had a time-segmented plan would come in and say, okay, my accounts are down, I understand, but according to the plan, Scott, my income's not coming from stocks, and the part of my portfolio that's down is the investments that we don't need for 15 and 20 and 25 years. Is that right? I said, yeah, well, that's how it works. So the question then ended up being from them, so how long do markets stay down? And I'd show them, well, historically they stay down for a year or two, then bounce back up. And so the idea is, well, then we're okay then, right? Because we don't need this money for 20 years, we're going to be all right. And the answer is, of course, yes. And historically, we know that you know, the markets bounced up about 400% between 2009 and the latest crash back in the spring of this year. So anyway, a plan is an antidote to panic. I guess that's the point that I would like to bring out. So what can you do now? You know, you've seen how a professional time-segmented plan looks. The question for today is, well, what can you do to prepare for retirement? There's several things. First of all, you need to create a retirement budget or figure out how much you're going to spend during retirement. Now, creating a budget may sound easy, but it's not. Frankly, you've never been retired before, so it's difficult to estimate how much you'll spend during retirement. So good luck with that. There's some online resources you can go to maybe help you figure out what your retirement budget will look like. Second, you can get to know your pension plan and your Social Security benefits. Consider ways to enhance your income from these sources. Surprisingly, many retirees make these life-altering decisions regarding Social Security and survivorship pension options with very little thought while sitting in their benefits office at work on the last day of work or while sitting in the Social Security office. Okay, think in advance. You know, what can you do to maximize your Social Security and pensions? Number 3, consider how much income you'll need to accumulate in your IRAs and your 401ks to provide for you the retirement income that you'll need. A couple of formulas can help you with this plan. You can probably go online and find some formulas that would help you to figure out exactly how much you need to accumulate. Number 4, time segment your investments now that you'll be drawing income from during retirement. That means some of you should invest more into equities. Some of you should be investing less into equities. So let me give you a good rule of thumb to follow. Money that you'll need in 0 to 5 years, you should not have any equities in this. This should be in fixed income. Money that you don't need for 6 to 10 years, I would have an equal mix of equities versus fixed income, so a 50-50 mix. And then money you don't need for 10 years and beyond, this should be invested in a diversified portfolio of equities. Number 5, create a retirement income plan. Again, distributing retirement assets is more challenging than the accumulation of assets was during your working years and less forgiving. Seek professional help as needed. You need someone that understands retirement issues such as Social Security, pensions, and taxes, as well as investing and the art of income distribution. Oftentimes, the advisor that helped you accumulate for retirement isn't adept when it comes to helping you to manage your investments during retirement. You need a professional to help you develop, and some of you need a professional to help you to develop and stick with a retirement income plan. Number 6, believe in the future. The end is not yet. Temples must be built. Missionaries must preach the gospel to all the world. Ordinances must be done for the living as well as the dead. Until God changes the order of things, all these activities require economies. They require money. Believe in the future and understand the cyclical nature of the economy and the markets. When things comes to an end, I don't think any of us will be thinking about dollars. We'll be fully engaged with things of greater importance, not money. And then we have, finally, number 7. Consider your personal financial stewardship. Not very many years ago, all the property you own now was controlled by somebody else. It belonged to somebody else. In a relatively few number of years, or upon your death, all the possessions you currently own will again belong to somebody else. The only thing permanent about your wealth is the stewardship you have over the resources that pass through your hands during your lifetime. Now, our Creator doesn't need our money, yet He has chosen to bless us with resources, and He expects us to be wise stewards and to use our resources to build up His kingdom here on earth. As we read the parable of the talents, we recognize that we are expected to be profitable and wise stewards. It was the prophet Jacob who said, "But before ye seek for riches, seek ye for the kingdom of God. And after ye've obtained a hope in Christ, ye shall obtain riches if ye seek them. And ye will seek them for the intent to do good, to clothe the naked, to feed the hungry, and to liberate the captive, and administer relief to the sick and the afflicted." Could the intent to do good also include supporting ourselves as we redeem the dead, supporting ourselves as we preach the gospel, serving in our communities, and supporting ourselves as we participate in wholesome recreational activities with our families? I think it does. It's been a pleasure to spend time with you today. I hope I've planted some seeds that will help you to enjoy a prosperous retirement, and that you'll be able to focus on that which is truly most important during your retirement years, not money. May God bless you as the stewards of your respective retirements.